about staking, what we see for developments. Me, the researcher for Vienna Blockchain Center. Now, staking, let's start with the basics, which you are always probably familiar with. I mean, staking is the process of locking up native cryptocurrency within the protocol as part of the consensus mechanism of the protocol. Simple. Why do you do it? Because you are a good person. You help secure the network. Another reason why you do it is that you can earn rewards with that. So new cryptocurrency tokens of the protocol are issued and are distributed to the stakers. So that's the basis of staking. This concept, this proof of stake consensus mechanism is pretty old. I think it was first implemented in 2012, like the line of communication. They are long. It really took off, let's say, in 2022 with the emergence of Ethereum. As you remember, where Ethereum switched from proof of work consensus mechanism to proof of stake consensus mechanism. And basically, what that meant is that you switch the security of the network from secured by hardware and energy to security which is secured by capital. Now, what staking evolved over time, and basically we start with solo staking, so you operate a node and you participate in the staking process. You have to log the cryptos there, so it's pretty liquid. You had to know what to do, like so you had to operate the node. It was very capital intensive, at least for Ethereum, where you needed for A to B. But you received the rewards. Now, this tech area and the high capital that it requires will pretty soon lead to something which you could call staking pools or delegated staking, where you basically a lot of little contributions into a pool, and the pool will do the staking. So you got rid of this like low capital and tech area. Now, the next evolutionary step where we are currently in and where there's a lot of experimentation is liquid staking. Basically, that's kind of staking pools, but the pools distribute tokens for the contribution of the stakers. So you put down your ETH or your Solana and you receive a liquid staking token. And why you do that, or why this was introduced, is that you get around this liquidity and lockup constraints. So you can pledge collateral in the staking process and you get a token, which you can immediately reuse for other purposes. So this is very capital efficient if you want. Of course, it comes with a set of specific risks, because what you have to be aware, it's like if you distribute the staking token at the end of the day, it's a derivative. It's a derivative of the original staking position. So you have very risks coming with it, and you have such special risks of derivatives like pegging, meaning that basically the liquid staking token should represent the original capital, but there is no law of nature guaranteeing that. So there can be price divergences. Now, maybe to kind of put this staking into a bigger perspective, this is actually a rather between some protocols. If you look here at Ethereum and Solana on there, and the staking ratio, so the amount of token stake, that's like 20% for Ethereum, and 60 or more than 60% for Solana. And it's a whole ecosystem and environment where you have a lot of protocols offering these services, and they are of, let's put it that way, a decent size. I mean, they are not huge, but they are of a decent size. Now, how could we place these liquid staking tokens on a bigger map? And what's so interesting about it is that they actually introduce what I would say a new DeFi primitive. So you get this token based on the stake, it's a derivative, you can do stuff with it. Now, two questions or two avenues in how to expand that is number one, you can think about how you structure this liquid staking token in order to achieve some goals. And then, of course, how you use it in other DeFi applications. So let's start with the structure. And this is what you've seen very, like a lot of experiments in the past, let's say 2 to 3 years. And that's yield stripping and yield unbundling. So what do I mean by that? Yield stripping, people who are familiar with have a TradFi background, for them that's nothing new. It's basically, you have the staking position, which is your principal capital and any accrued earnings, and you separate this. So you basically make two tradable assets, a principal token, which represents the principal and small yield component, and the second asset, the yield token, which basically only represents the cash flow out of the staking reward. So this comes pretty handy if you have certain conceptions about where the market is going, because you're not locked in with like the whole position, but you can rather choose the cash flow you want. Of course, you can take this one step further and unbundle the yield component. Because normally the yield you earn with staking, you normally have some basic fee, basic income, then you have transaction fees, then you have on top of that something like MEV. And that looks, I don't know if it's very, it's not very big. For Solana that would look like that. So you earn your staking rewards. But there's nothing in the world that prevents you from splitting that up. And so isolate the base income or the basic fee you get from transaction related fees. If you split it up, you once again can isolate reward components, and based on your conception of where the market or the protocol is going, choose exposure to certain cash flow streams. So that's really enough. If we look at how you can use those things in token, I mean, one thing sorry, that is more done is called restaking, which basically means you use the liquid staking token to secure something else. So you stake it in another protocol or another peer, which is also referred to negatively validated services, and earn a second yield. Not bad. Of course, this comes with additional risks. Eigenlayer, for example, is one of the protocols who kind of create this approach. And then, of course, liquid staking token, it's a token, you can use it for anything that you can do in DeFi, which is like use it as a collateral for a loan, use it in an infinity pool, for example. And it wouldn't be crypto if you couldn't do that in a leveraged way. So you have like kind of a looping strategy. You stake 100 ETH, you get 100 ETH stake ETH, you put it in a protocol like ARF as a collateral, get more ETH, and repeat the whole thing. So you could leverage your position. And other functionality built with these liquid staking tokens is something like point farming, and the service that is coming more and more onto the market are so-called yield walls, which basically automatically manage your staking positions. I mean, what could possibly go wrong? It's always a question you should ask yourself. I mean, the staking token and everything that is built upon them is DeFi. And DeFi comes with risks, so it's no risk-free things. And these, if you use them, you should be aware of at least the basic risks you have. Like, I mean, every staking activity comes with the risk of slashing. So if you do not behave as the protocol expects you to behave, your stake can be slashed. I mean, that's the whole point in proof of stake. But of course, you have other risks like lock-up risks. So you stake, you don't get your money back in time, volatility. Then all the smart contract vulnerabilities that we often encounter in DeFi. And of course, if you do it with custodial staking service, you have counterparty risk. But as a user, one should be aware of it. Now, of course, in the community, like these risk discussions evolve a little bit around other things, more like from a systemic perspective or systemic risk perspective. What we see in certain protocols, and for example, Solana, you have certain concentration of staking providers. So I think Jito is the biggest, with 40% or so market share, and this might pose a problem with the overall security of the protocol. The second thing, what we see in every bull market, of course, is that users underestimate the risk that's associated with like more complex DeFi structures, and associated with that and with the institutional adoptions, where we heard a little bit about today, is of course regulatory scrutiny, because liquid staking tokens, they are based on staking, which secures the security of layer 1 networks. Now, if significant amounts of money go into layer 1 networks, and we've seen that with, for example, Ethereum ETFs or with treasury companies, this could pose a systemic risk that a regulator might want to look into. That, I think, is all from my side. In short, any questions or comments? Or are we already about? I think there's a panel before that.